Hey everybody, Brent Morris here. Time for Investing Masters Series. I'm sitting in for Mr. James Boyd, who's out for a few days here on some well-deserved PTO. So I'm glad to be here with you. I'm also glad to be joined by Barb Armstrong, whom, for many of you know, has been out for, I don't know, several weeks now with some important health, important surgery for her future mobility. We're glad to have you back, Barb, and so you can look to see her in her regular webcasts as well. So feel free to follow us on X at Brent Morris CS, at Barb Armstrong CS. And as we get into this, just remember, we're going to talk about options today, actually. So options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money software application is for educational purposes only. May not factor in commissions or fees into these example trades that we use, but just realize they are an important thing for you to consider. All investing involves risk, including loss of principal. And let's see, past performance is no guarantee of future results. Short options can be assigned at any time up to expiration, regardless of the in the money amount. There's no guarantee of execution of a stop order is going to be at or near the stop price. And there we go. So this is what we're going to do today. We're going to briefly look at the overall market. Then we're going to talk strategies to potentially enhance or protect your portfolio. So today in particular, we're going to discuss LEAPS options as a potential enhancement to your portfolio. Now, it's not for everybody. I'm going to try and go through pros and cons, but I think you should be aware of what they are because you may find them helpful, a helpful addition to your portfolio. And maybe you look at them and go, hey, not for me. That's okay too. But you don't know until you look at them and consider them. So that I'm going to kind of compare them to stocks in some ways. They're not stocks. I'll talk about some of the differences here just in a minute, but we'll go through examples here as well as we look at this. So let's bring up the Thinkorswim platform. This is the SPX. This is the S&P 500. We're off a little bit today. I just have a plain chart here, but you can pull up here's a 20 and 50-day moving average. We're above that 20-day. That's a simple moving average. Here's a 10-day EMA in the red. We're actually right at that. You could use a whole moving average. I know a lot of you and James' class like to use whole moving average. It doesn't matter. We're kind of saying the same thing right now. The trend has been going up. Now, we're having a little bit more of a pullback on the NASDAQ. And sometimes you're probably going to question, well, is this the end of the trend? Because look, we've had a great trend on the market. I'm not saying it's going to continue. I'm just saying that's the trend that we've had. And then you go, well, maybe this is the end of it. Well, nobody knows when the end of it is. But one thing I would do as a technician is I would consider looking at the trend, look at what it's done, what it's doing here, this pullback, in other words, and say, is that very different? Is it out of character for the other pullbacks that we've had in the market over this period of time? And if you say, no, this seems to fit kind of within what the other pullbacks have looked like, then you may go, look, I'm going to need more evidence before I call right now. But when we're talking about your portfolio, you may very well have a stocks portion of the portfolio, an options portion of the portfolio. Maybe you have bonds in your portfolio. Maybe you have a whole array of asset classes in your portfolio. Great. But likely, it's not just one monolithic thing. You're going to have a more aggressive part of a portfolio, perhaps, and a more conservative part of your portfolio, perhaps. What I'm going to be talking today would probably be a little bit more in the more aggressive part of the portfolio aspect of your portfolio. This is not a recommendation of for a whole portfolio there. Okay. So we're talking about LEAPs. What are LEAPs? LEAPs, it's just an acronym. It stands for long-term equity anticipation securities. It's just a long-term option, folks. You guys who know options, and I know James talks about options all the time in this webcast. Those of you who know options know a lot of the basics of options. We're just moving the date out on these. Probably typically when we're looking at options, maybe you're looking out a couple weeks or a couple months or something like that. Here we're looking out a year or more even for what LEAPs are. But the basic rules apply to both. And what I'm going to submit to you is this is kind of a hybrid in a sense, okay, between the stock portion of your portfolio and the short-term options portion of the portfolio. These are options, to be sure. And when we talk about LEAPs, there is an expiration date, right? Stocks don't have expiration dates. So that's a difference between stocks and LEAPs. If a stock pays a dividend, for example, great, stock pays a dividend. If you own the LEAP instead of the stock, you're not going to get that dividend. So just keep in mind, these are not stocks. But what these can provide is they can provide a more maybe leveraged approach to your portfolio here. So let's take a look at an example on this. So I'm just gonna pull up CSX, okay? CSX, and I'm gonna pull this up. Here's my, this is just the unadulterated chart, no technical indicators on this. Just look at the trend. This is the trend that we've been, and I'm gonna assume for our purposes that trend is going to continue. If you're a trend trader, that's a common type assumption. Maybe you want to look at other things like here's a 10-day exponential moving average on CSX as well in the red. Okay, you can look at whatever other indicator you want, and you're just going to come to the conclusion: am I more bullish or not on this? LEAPs options are the reason we're doing LEAPs is we're planning on holding these for a little longer period of time. This is not for a swing trade. We're not planning on getting in and getting out in 2 weeks. Now, maybe there's circumstances that will kick us out, force us out in the next couple weeks. That's a possibility, but that's not the intention or the goal. The goal is to be a little bit longer. Now, so let's consider the whole LEAPs thing here first. But I want to talk to you initially about the leverage here a little bit. If I buy 100 shares of stock, okay, so we're going to talk about buying 100 shares of stock. My delta is going to be 100 on those. Okay, you got that concept? 100 shares of stock is 100 delta. Let me move this out to the side here. How much is 100 shares of stock going to cost? It's going to cost $3,683, okay? Price. That's 100 shares of stock. I'm just going to put it in as a per share cost though. $36.83, that's the cost of the stock here. Okay, let's go to the LEAPs here for a sec. And so what I'm going to do on the LEAPs is I'm going to go out here and we're going to go longer term options. So I'm not looking 3 days, 7 days, a month. I'm going to go out somewhere roughly a year. Well, look, we can go out longer. I mean, we can go out to, we have options that expire in 2027, June of 2027, if we wanted to. I'm not going to go out that far. I'm going to go out about a year where there's nothing exactly a year. I'm going to go to September 18th, 26, okay. And I'm going to go in the money just a little bit. We got a 69, around a 70 delta is what I'm going to target here on this, okay? I'm not going to do that. Let me look for another one here. And here's why I'm not going to do that. Do you see this? This is why I'm not going to do that, okay? There's just no liquidity. Look at the bid-ask spread on those. Just way too wide, okay? So I'm gonna bypass that. We're gonna see if we have some other contracts that will serve our purposes here, and if not, we'll look for another stock. Sometimes we need to go and look at a different stock here. Liquidity on this one, any bet? No, still no good. Okay, so technically stock is kind of fits the bill from a liquidity standpoint? Maybe not. Let's see what we got. Yeah, I'm gonna pass there. It doesn't matter. I'm not gonna do something with the bid-ask spread this wide here on this. Now, Greg said, oh, add an open interest column. I can add an open interest column, but I don't care if there's a million open interest here. If I have this big of the difference between the bid price and the ask price, I'm not going to do that. We're not going to do that. So we're going to skip CSX here in this case. So let's do another one. Let's look at a different example, okay? So I'm going to let's go to Halliburton, okay? So here's Halliburton. Generally, I'm going to take more of a positive view on Halliburton. Generally, we're getting higher lows. And by the way, these are longer term options that we're looking at. This is a longer term trade. Do you know, let's say you're a fundamental analyst, or you like fundamental analysis, okay? That probably, for most traders, if you are interested in fundamental analysis, you're not looking at a 1-month trade. You're not looking at a 2-month trade. Because over the short term, generally there's more emphasis by most traders on just the technical analysis. But once you go out further in time, okay? Once you go out further in time, then maybe the fundamentals start to make more sense to look at. Okay? So short-term technical analysis, longer term technical analysis, maybe some fundamental analysis. Now, what are you going to look for? It's up to you, but some people will look, maybe you could look at third-party analyst reports. Okay, you can do that. You can look at buy, hold, sell. You can look at the details on the reports. I'm not going to do that today. And just remember, these guys get it wrong, but some people like to look at those reports there. Okay, from a fundamental standpoint. You can read about the company. You can also look and see, in general, is the trend going better? Is the trend of earnings getting better? Yeah, in general, we'd say the trend of earnings is going up there, okay? In general, am I selling more? In general, that trend is going up, okay? So you can look at things like that, all right? You can look at your fundamental analysis on this. You can look at your profit margins, your operating margin, your gross margin, your net profit margin, and see, is it getting better or worse? Those are the kinds of things you may look at. But for the most part, we're going to stick with the technical analysis. We're going up. What's our long-term forecast going up? But let's do this. Let's go back here. I'm going to just change that example. Delta on 100 shares is still 100. Okay, we're changing our stock example here. And what I'm going to do is, our stock price is 21.37. Okay, 21.37. So let me put in 21.37, and this is a cheaper stock. One advantage on doing leaps sometimes is if you get a real expensive stock, it can be quite expensive if you were to do 100 shares. All right. Well, in this case, this is kind of cheapo stock, but we'll still illustrate the difference here on this. Let's go out. I'm going to go out about a year. I think we're going to have tighter. Yeah, these are much, much better, much better. Okay. And I'm going to go to, I'll go in the money. I'm going to go to the 64 delta here on this. And our price is about $4. Okay. 64 delta, $4. Let's put that in here. Okay. Delta, 64. Price, $4. Now, I want to think about the leverage. You may be thinking, look, Leaps, the stock has a higher delta, therefore there's more leverage on that. But what you need to do is you need to consider the delta as compared to the price you're paying for it. Okay, the movement, because what's delta? Delta is how much this option position or stock position in this matter is going to go up or down with a $1 move in the underlying stock. Underlying stock goes up $1. If we have 100 shares, we're going to make $100. That's our delta. Underlying stock goes up $1, and we have this LEAPS contract we pointed out, we're going to make about $64. Approximations, right? Approximations. And same thing if it goes down. Now, delta changes as the stock changes, delta changes over time, but just as an indication of what we're looking at here, I'm going to take my 100 and I'm going to divide that by 2137, excuse me, 2137. And I come up with about 4.67. Let me put that down. We're going to call this kind of our leverage factor. Okay. LEAPS, 64 delta, divide it by $4. I come up with about 16. Okay. Do you see the leverage there? For every dollar move, we're getting so much more movement out of the LEAPS contract here on this. Now, is leverage good? No, not necessarily. Is leverage bad? No, not necessarily. If things are going your direction, leverage is great, right? If things are going against you, leverage is terrible. You know, ask people who, bought houses right before the, with zero money down right before the financial crisis, if leverage is good or bad. No, so in other words, we're kind of banking on things going up if we're going to implement leverage here. So what you need to do as an investor is you need to decide, do I want to increase the risk of my portfolio for this particular part of my portfolio? Remember, this isn't for the whole portfolio. We already went over that. And if the answer is yes, this is a possibility. This is a possibility. Now, we are foregoing dividends, right? And this is not an infinite trade. This doesn't go on forever. This goes on, how many days did we say? 395 days. Okay. Let's say, well, what dividend are we giving up here? Here's Halliburton. About 3% yield. Okay, so that's a healthy yield. We're foregoing that if we buy this LEAPS. But we are also, if the stock cooperates and goes up for our longer term, we're increasing that. We're increasing this. So that's what I'm going to do. I'm going to look at this and I'm going to put in a stop loss as well on this trade. So here we go. We're looking at the $20 call. I'm going to right click on this. I'm going to buy custom with the stop. Now, if I'm doing this stop, I can do the stop based on a traditional stop based on the option price. Okay. We're buying for, what do we say, $4. And we could put in a price to get us out if that LEAPS falls. If instead, and how much? Probably over 50%. A 50% stop, we're going to say $22, right? If I'm buying for $4, $2. If I'm doing something with maybe going in the money a little ways, I could make it a little tighter. Maybe up to 3, maybe 250, 275. In other words, if I have a delta that's about 50, very often, just kind of rule of thumb, this is not you don't need to do it this way. But if you have a delta around 50, if you're doing your options around right at the money, often the stop will be closer to 50%. As you go further in the money, then often we'll put the stop a little bit tighter. They tend to be a little less volatile in terms of the magnitude of swings here. The leverage on the out of the money or the at the money contracts is typically going to be a little bit higher than the leverage on the in the money contracts. Why is that? The delta's higher. That means more movement. Remember, leverage isn't just the amount of the delta, it's the amount of the delta per the cost of the trade there, okay, per the cost of the trade. So if we're looking at a $4 option and I have something around the 60, 65 delta, I may put in a stop that's about 65% of that. Just so that'd be putting me a stop in around 260. But the alternative is we can do this. We can also say this. And remember, when we talk about stops, they're not guaranteed to get out at whatever price we state, okay? Whatever price we put in on a stop doesn't guarantee that we're going to get out at that price. But I could also say, look, this is a longer term trade. I can do a longer term support level if I want. I can look at I can do whatever. I could find a support down here where we've bounced off of multiple times. Okay. Bounce, bounce, bounce. Didn't quite get down there on this one. And I'm going to go a little bit below that. Okay. So a little bit below $20. I'm going to say $19.75. And I can say, I'm going to do this trade. And instead of doing this on the option, I'm going to do it on this based on the stock price. I'm going to make this a market order. I'm going to make this good till canceled. And it didn't like that. For some reason, this has been doing this to me lately. We're going to do this again. I'm going to buy custom with a stop. Good till canceled. Market order. I'm going to click on the gear over here. Okay. I'm going to click on the gear over here. And we said 1975. So I'm going to go under here where it says submit. We're going to submit this sell order when Halliburton marks less than or equal to 1975. 19.75. Save quantity. I got one contract in here right now. Now I can do more, but you consider your position sizing and where this fills in there. Now let me answer questions here on this one second. Let me just put this in. This is going to be a long single option. It's a leaps, but it's an option. Okay, we put that in. Okay, question in the chat was, are the theta zeros because they're longer data? Okay, so let's talk about theta here on this. This is good. So theta is these numbers here. When you're looking at Thinkorswim, it rounds the numbers. You can change the decimal point rounding. I have rounding to the 100th here. So technically this isn't zero. If it's probably 0.0008 or something. I don't know what it is, or 0.004 or something like that. It's rounding down to zero. So technically there is time decay on these. But one advantage of the leaps, because remember, when you're buying calls or buying puts, the leaps are, when you're buying calls or buying puts, short-term or long-term, time decay works against you. Theta is positive. It's beneficial to minimize that. Now, as we get closer to expiration, those thetas probably aren't going to show zero forever. They'll eventually go up. But presumably, you have a long time for this trade to work out for you. So that's the advantage of those. Okay. So let me just see. Are there other questions on that? So that was a very good question, RTR. Thank you on that. And I thank you, Barb, for helping me on questions. Appreciate that. Let's move on. Now, here's the great thing about leaps. Okay. And again, there's pros and cons on this, but they're also an avenue to do bearish trades. Can you do a bearish leap? Yeah, you can do a bearish leap. This is just the puts. We could do a leaps put on this and find a bearish stock. Okay, here's a portfolio. Here's a portfolio. And I'm not going to put percentages because I don't know exactly what percentage you're going to want. There's a decent chance your portfolio is going to have a sizable chunk of maybe stocks in there. Okay. This is an overall portfolio. Maybe we have maybe you have some bonds in here. I don't know how big that bond is. It probably depends on your risk tolerance, your age, and stuff like that. I'm not going to get into specific percentages here. Maybe you have some alternative investments. Maybe you have gold or precious metals. Okay, maybe, not a recommendation. Maybe you even have a little, some alternative investment of some sort that's more speculative. And then you very well may have a more aggressive part of your portfolio. And that aggressive part could be options, it could be futures, it could be something else that we're not going to talk about here. But the leaps is going to fall more in this options aspect of that portfolio. But it's not as, why do I say it's a little bit more on the realm of stocks than in the realm of options? And here's the reason why, okay? I may have misstated that. Clearly still an option, but think about what the pros and cons are of shorter term options. Shorter term options, you have the theta, which can be a big drag on this. The theta is less of a drag, okay? The day-to-day impact on your portfolio is less of a drag on this than it would be with a short-term option. Short-term options, you have expiration dates that you're constantly having to deal with. Yes, you still have an expiration date, but it's not nearly as soon. Short-term options, you have more leverage. I'm not going to go through the calculation on this typically. This is a little bit less leverage. It's more leverage than the stock, but it's less leverage typically than the short-term option there. Okay, so there we go. And so we've talked about pros and cons on this. Let's take maybe a little bit more of a bearish example here. Okay, so here's what I'm going to do. I'm going to look at, let's look at Coke. Okay, kind of trending down, not a massively quick trend down, but it is kind of bleeding, so to speak, a slow bleed on Coke here. Okay, so we're going to call that the general trend on Coke. And could we do a leaps put? Yes, we can do a leaps put. So let's take a look at that. I'm going to use essentially the same rules here. I'm going to go out. Now, how far can you go? You can go out as far as you want. You can go out longer if you think the long-term prospects are bleak on it. You can go out a little shorter. Here's June of 26. And I can look at my puts, and I can go here, and I can look at my delta, and I can go in, and again, I'm going to go in the money a little bit. If I go, you can go deep in the money, and you can go, that's okay. You can go deeper in the money. You can go up to 90 delta. It's still going to be a lot cheaper than the stock. Let's talk about bullish here for 1 second. I'm going to do a put on this, but just think of the cost of this. Let's say we went all the way up to this 88 delta on the stock, and we were buying the stock. You're going, that's a $1,600 option, Brent. That's really high. That's really expensive. Well, yeah, that is a pretty expensive option, but how much is the stock? The stock would be $7,000. $1,600 versus $7,000 is pretty cheap. Now, if we're talking about puts, the kind of complementary trade, so to speak, would be shorting stock. Okay. A lot of you are interested in going bearish on the market, maybe even shorting stock, but you're a little bit iffy on shorting stock. Remember, shorting stock has an unlimited risk. Okay? If you short Coke, you sell stock in Coke and you don't own it, there's a theoretical unlimited risk on it. The higher Coke goes up, the more you lose. Well, what about the put? Let's say we do a leaps put. We'd say the 75 put here, okay? Well, it's going to cost us some money. It's going to cost us $700 for this. $700, which And believe me, you can lose every bit of that $700 there. But it's not a theoretical unlimited loss there. All right? There's not a theoretical unlimited loss. So that is one maybe advantage of doing the Leaps put versus just buying or selling stock short on that. So let's do our little comparison here again, though. Let's look at the leverage element. 69.73 is the stock. The delta, minus 100. Price, 69.73. Max loss, theoretically unlimited if we're shorting that. Okay. Option, I'm going to go to, what did we say? 75, minus 64 delta. Delta. Minus 64. What do we say? Price 7. $7. Okay. What's our leverage here? I'm going to take 100 divided by 69.73 is equal to 1.43. 1.43. I'm going to take 64 divided by 7. I come up with about 9. Okay. You see why it's a more aggressive type trade when we look at this? There we go. Okay. Again, we'll put in a stop at some point on this, an exit on this. And it doesn't mean it's not going to protect us necessarily from the $700 max loss on that for a contract, but it's because the volatility could take you past the exit point. But we'll put one in anyway there. So Leaps put, I'm going to the 75. I'm going to right click on this. I'm going to buy custom with stop. I'm going to change this, good till canceled. I'm going to make this a market order. And my stop, where's my stop? Well, we're going to figure that out. We're going to look at the chart. I'm going to say, look, this was our recent peak on this, right up here. My plan is to hold this for a long period of time. 71. I'm going to go above 74. I'm going to give it a little wiggle room here. This is a longer term trade. Now, if this were a swing trade, would I put a stop up here? No. If this were a swing trade, this were a swing trade where I'm going like, I want this to go down here. Yeah, and I'm planning on exiting, targeting right here. No, but this is a longer term trade. But for a longer term trade, can I see this kind of wiggle up and down? Yeah, but I'm going to cut bait, so to speak, at 72, or perhaps a little less, something like that. So let's do that. Here we go. I'm going to click on my gear to exit. We're going to say if Coke marks greater than or equal to, and I'll go a little bit below 72. I'm going to go 71.80, just so we don't have that nice round number there. And I'm going to click on save. There's my trade for one contract. I can click on confirm and send. Max loss, $700. That's a lot better than the theoretical unlimited risk of shorting the stock. It's leveraged. It is an option. We do have an expiration date. And by the way, if you were to short stock and the stock pays a dividend, you're responsible for paying that dividend. In this case, you're not. Okay. So that's one advantage. Pros and cons, folks. There's pros and cons on all these. So there we go. Let's send. Actually, I'm going to put that in the right bucket here. I'm going to do long single options. I have my exit. I have my purchase. We're going to send that trade there. Okay. So there we go. We filled on that. So that's a bullish trade. That's a bearish trade. Okay. Now, let's look at you can do others. Let me just kind of hit up one of the points that I was looking at initially. So here's KMI. Okay, here's KMI. And let me just mention this to everybody out there. I am not allowed to talk about taxation on these things or tax issues on this. So you're going to need to talk to your tax advisor for tax purposes on these. KMI, bullish or bearish? Well, I'm going to call that bearish. Okay, I'm going to call that bearish. I'm below my 10-day exponential, lower highs, lower lows. Is that a possibility for a leaps option? Yeah, sure. You could look at it. Again, we're going to double check our liquidity on that. You can check different expiration dates. I don't need to go out a year. I can go out 213 days here on this. But at a certain point, at this point, if I go to like December, we want to consider that a leap at this point. Okay, that's just a longer term option. I can go out 514 days if I want. You can add in your open interest columns if you like. There's your open interest columns, and you can kind of see where it's at. What's my delta? By the way, volume. I wouldn't worry about volume, to be honest, in terms of options. Worry more about open interest than volume. We've got a fair amount of open interest on these. If you're in the hundreds in open interest, usually that's going to be sufficient. You can also double check your bid-ask spread. There's your calls. Here's your puts. Double check that bid-ask spread, open interest. I would not worry as much about volume there on those. Okay, volume resets every day there. Okay, now, can you do these trades on index options? You can. I'm not going to get into index options today. In fact, we have a webcast on the index options, trading index options. It's Wednesdays, 11 o'clock Eastern time. Make sure you check that out. There we go. Let's do it. I'm not going to go through the leverage element on this time there. But let me go. I'm going to change this to delta, just so we get an idea on delta. I'm going to go in the minute. I'm going to go to that 70 delta, 600 open interest. That seems reasonable. It's going to cost me about $465 on that. And I'm going to look at the chart. I'm going to find my exit point. Okay? I can go up here and say, this is kind of a resistance level. I'm going to use our lows there as a support. Maybe go down a little bit where we bounced off. I don't know. Well, we hit off right there. I'm going to call that. And I'm going to say if we break above that, 27.5, I'm going to get out of the trade. Okay. And let's talk about volatility in Vega here as well. Okay. Is this a positive Vega trade or a negative Vega trade? Okay. Remember with stocks, a stock isn't affected by implied volatilities. Stocks are not affected by implied volatilities. Long options, long calls, long puts are positive Vega. They benefit if implied volatilities go up. So this is a long Vega trade. Let me just go back. Let me just jot this down and let's go back to our prior screen here. Trade, we're going here. Let me just look back here for 1 sec. Let's compare short option Greeks, short expiration date Greeks. I don't need that many strikes with longer term expiration date Greeks. Let's look at our Theta and our Vega. Theta, Vega, not huge. It's not an expensive stock here. Theta, Vega. Notice the Vega is higher. Theta, we were saying the Theta is lower. Okay. Time decay is less as you go out further. This isn't affected by implied volatilities. So if we look at KMI and pull up a implied volatility, let me just see if I can pull this up so we can see. Where are we? here we are. We're kind of about as low as we've been. This would tend to benefit if implied volatilities go up. I don't know what implied volatilities are going to do, but whatever implied volatility does, it tends to mean revert. In other words, if it spikes up to 45 or something, it's likely not going to stay there. You never know, I guess. You never know. But here's the thing. With KMI, this implied volatilities are likely to go up if the stock goes down. Okay? If it drops precipitously, implied volatilities are likely to go up even more. So that's a good thing. That's going to work against us a little bit on the call leap. If the call leap goes up, if the stock goes up on the call leap, like we did that example on Halliburton, then that's going to kind of keep that IV suppressed, which is not going to benefit us on the trade there. Okay? All right. So let me just do this. Let me go and let's do the trade here. Let's do the trade. So, and then we'll just finish up with maybe one last question here. Let me right click, buy custom, stop, good till canceled, market, gear. We said if KMI marks greater than or equal to 2750 is going to get us out. Okay. Save, confirm and send. And send. Okay. So there's our trade. So we did a long call leaps on Halliburton. We did a long puts leaps on Coke and a long put leaps on KMI there as well. Okay. Let's see. And there we go, folks. I think we're going to wrap it there. All right. So thank you very much for joining me today. I am out of time. Let me just, I think there's one more question. Why not sell calls for leaps call at Halliburton for a DAG? You can add other options. So that's kind of outside the scope of what we're doing today. But could you do this? I did a class, a webcast a couple weeks ago on what we kind of labeled informally a poor man's covered call. And that's kind of using this strategy here. All right. But you can search in the Trader Talks channel for poor man's covered call if you want and look for that. But that's certainly a possibility, no doubt. Hey, I want to thank you all for joining me today. Coming up next, we have Getting Started with Options. So Cameron teaches that class. Make sure you check that out. Barb, thank you for your help in the chat. We're glad, everybody, we're glad that Barb is back. It's good to see you, Barb. And James should be back for this class next week. Bye-bye, everybody.